Here's a shocking fact. AI chips power 90% of the world's technology, but most investors still don't own a single semiconductor ETF.
And those who do could be sitting on one of the biggest long-term growth opportunities of this decade.
Welcome to WealthBuilder, where we break down proven strategies to invest and build wealth. Today, we're revealing the best semiconductor ETFs that could supercharge your portfolio over the next 5 to 10 years.
Stick around till the end. You'll learn which ETFs to watch, how to manage risk, and how to use AI trends to build long-term financial freedom.
Semiconductors are the brain of every modern device, from AI systems and electric vehicles to cloud computing and robotics.
As demand for data and automation explodes, chip companies are becoming the backbone of the global economy.
Just think, every AI model, every smartphone, every electric car relies on chips. That's why semiconductor ETFs are one of the smartest ways to invest in the infrastructure of innovation.
Unlike picking individual stocks, ETFs give you diversification, spreading your risk across the biggest names in the chip industry.
First up, SOXX, the iShares Semiconductor ETF. It tracks the ICE Semiconductor Index and includes top companies like Nvidia, AMD, Broadcom, and Qualcomm.
This ETF has delivered strong double-digit annualized returns over the past decade, thanks to the rise of AI and data centers.
Expense ratio just 0.35%, making it efficient for long-term investors. If you want exposure to US-based chip giants, this is a solid foundation. Next, SMH, one of the most popular semiconductor ETFs globally. It focuses heavily on the biggest names driving chip innovation: Nvidia, Taiwan Semiconductor, and ASML.
SMH is slightly more concentrated, meaning higher risk, but also higher potential reward when the AI market surges.
With the chip race heating up between nations, SMH gives you exposure to global leaders in AI hardware manufacturing. Third, XSD, the SPDR S&P Semiconductor ETF. What makes it different? Equal weighting. Every stock gets roughly the same size in the portfolio.
That means smaller companies like Marvel on semiconductor and monolithic power have room to shine, not just the mega cap names.
For investors who want balanced exposure across the entire chip industry, XSD is a strong long-term choice. Here's how they stack up. SOXX, diversified US-focused, stable growth. SMH, concentrated global exposure, high momentum. XSD, equal-weighted, balanced performance.
Your choice depends on your risk tolerance. Conservative investors might prefer SOXX, while aggressive investors could go with SMH or XSD for higher upside.
Step 1. Research performance trends. Look at 5-year and 10-year returns before buying.
Step 2. Use dollar-cost averaging. Invest small amounts consistently instead of trying to time the market.
Step 3. Stay invested long-term. Semiconductors are cyclical, but always rebound stronger during AI-driven demand surges. Here's the big picture. AI, robotics, electric vehicles, and cloud computing all depend on semiconductors. This trend isn't slowing down, it's accelerating.
By holding a diversified chip ETF, you're not betting on a single company. You're investing in the digital backbone of the future economy.
Want your money to work smarter? Consider adding one of these ETFs to your long-term portfolio.
Don't forget to like, comment, and subscribe for more finance and money tips. See you in the next video where we break down AI investing strategies for real wealth builders.